We agreed to disagree. That's the outcome of the ceasefire talks over the weekend. Optimism swept through the markets only to get slapped down going into the weekly close. And yet, risk-on assets didn't blink as much. They delivered, I would say, a snapback rally. Bitcoin and Ether are showing signs of life, while alts are, broadly speaking, still in the gutter. So, chat, are we back? Let's find out. I'm Igor, Investment Director at Venionaire Capital, your entrepreneurial partner, and this is Crypto Insights. What is happening with ETF flows? What's changed over the past 2 weeks? A ceasefire frenzy during the last week actually brought optimism and a rally. Last week's US-based spot ETF flows increased significantly, with both spot Bitcoin and Ether ending the week with net positive inflows. Out of total 786 something million in net inflows for BTC, BlackRock's IBIT led the charge actually with some 612 million alone, which can be taken as a sign of constructive institutional interest at current BTC price levels. Ether also saw a rebound in investor appetite with almost 200 million in inflows. Altogether, crypto investment products recorded 1.1 billion in net inflows last week only, which is the strongest performance since early January this year. As we can see on the charts for the weekly and the daily overview of ETF flows for BTC, for example, on the daily overview for BTC, we can make an observation that while the BTC price went sideways, which is here in the orange line color, we see more ETF inflows, those green bars above the neckline. We saw more of inflows than outflows, and together with rising total net assets, which is white line, it actually indicates a certain level of accumulation. Looking at Ether spot ETF flows here, we can observe a similar development, albeit both Ether's price here in the blue line and ETF net assets, which is here in the white line, both have been somewhat steeper to the upside since the early February market crash. In isolation, spot ETF flows for BTC and Ether are, I would say, constructive, but do not signal a trend shift just yet. This is what we want and need to see to continue. But here's the important context behind these flows. The overall backdrop of global risk-on asset markets for 2026 was very positive going into the conflict end of February this year, and that underlines that the appetite never fully disappeared. BTC and Ether, being both 24/7 markets, are usually the first to absorb any headline noise and liquidation events during weekends. Yet both continued to hold their levels for over 2 months now. In itself, this is an indication of a steady but absorbing selling pressure so far. And during the last week, ETF flows backed this thesis up. Now, before we get into the charts, let's just look at what the COT positioning data is telling us. The COT's commitment of traders data for futures markets. Here we can see that changes in last week's COT data, week over week for futures contracts, shows actually that in aggregate, a continued increase in net short positioning for commercial hedgers, short here in gray, and small traders or retail folks are largely neutral or no position, here in white color, barely to see. And large traders are showed here in orange color, have increased their net long positioning. In other words, bearish positioning for BTC and Ether has persisted since our last episode, resulting in no positive change over the past 2-3 weeks. Instead, COT shows increased headwinds for both BTC and Ether. As a side note, the COT data has a time lag due to end-of-week reporting, but it's a strong signal for trend-aligned positioning. So any short-term rallies are still possible, of course. So it seems that we now have, let's say, contradictory signals, improving ETF flows on one hand side, but persistent bearish COT positioning on the other hand side. How did markets respond to that tension? At any signs of hope open optimism, the markets rallied, which is a very good sign. There is clearly a risk appetite and sidelined capital just waiting, itching to be deployed. Markets can rally, but any rally must hold and endure the next batch of risks, including inflation, labor market data, central bank policy decisions, and of course the ever-changing political statements or actions. And then came the weekend reality check. Over the weekend, the key decision makers sharpened their rhetoric, and markets that had hoped for a peace deal were now expected to show their disappointment, which would only become visible with a delay during TradFi market open hours early this week. Negotiations ended without a ceasefire agreement, followed by another blockade, which means bad news was followed by more bad news. Yet, U.S. equity markets rallied and erased the correction since the conflict outbreak at the end of February. More bad news brought more upside. So one can say that sometimes the markets seem irrational. Which brings me to something worth flagging. Some interesting notes coming from TradFi absolute heavyweights, JP Morgan Chase and Morgan Stanley. Both see the next 3 to 12 months period as favorable for adding risk-on exposure now. In other words, they say investors should buy market pullbacks, arguing that current conditions support a strong recovery despite lingering geopolitical risks, albeit with heightened asset price volatility. Morgan Stanley sees the S&P 500 correction as nearly over, with expectations of outperformance by international stocks, emerging markets, and small caps. Interesting to note is that these remarks by JP Morgan and Morgan Stanley come when the recovery has already largely played out, if not entirely. So why state the obvious unless if you want to be skeptical, this is your signal to be skeptical. Now, let's see where Bitcoin and Ether actually stand in the charts. As a reminder, here's the BTC and Ether chart from our last episode. And now let's take a look at where we currently stand. Both BTC and Ether are now trading inside the channel, a purple line, as you can see, after their deviations outside of it. This is a good sign of strength. Their lower boundaries are being carried upwards, sloping higher. Bitcoin is currently displaying strength and looks like it's gearing up to take a stab at that 79,000-80,000 upper resistance band, dollars, 79,000-80,000 US dollars upper resistance band, and it is trading back above its 200 moving average on the 8-hour time frame. And look at this here. Ether is already there at its upper resistance band around 2.4 thousand US dollars after it as well reclaimed its 200 moving average on 8-hour time frame. So since our last episode, BTC made several attempts to break and hold its local range highs around the same 71-72K upper band, which we discussed in the last video. So with ceasefire negotiations finding no agreement over the weekend, BTC pulled back at first and is now fighting the 75K level in a show of good strength. This level needs to give way before any attempts at 79,000-80,000 can be expected. So with Ether, as mentioned, Ether is already at its upper resistance band. It's already there. So it's now, it either breaks it decisively and continues upwards higher, or I would say at best consolidates there for some time. I would not like to see any strong rejections that would then hold and keep us below this level, below 2.4. Both Bitcoin and Ether need to put in a higher high on higher time frames, like the 3-day and the weekly. Again, as a reminder, here's where we stand now for the 3-day chart. We are a long way down from the tops of September and October 2025, and as you can see here, we already had a similar attempt to shift the trend on the second leg down. We could still end up getting a third drive down, which is possible, albeit less likely, I would say, for now at least. At the moment, Bitcoin seems to be in lockstep with US tech equities, both the S&P 500 and Nasdaq, which have erased the correction correction and reclaim their levels, as we can see here in the chart. The TradFi recovery is encouraging, but it needs to be treated with caution given the broader macro conditions that we still have. And the same applies to crypto, which brings us to altcoins. In the altcoin space, things are still looking pretty dire. There are too many altcoins and too much supply of each single one of them, all fighting for attention and I would say more importantly for scarce liquidity. The altcoins dispersion and disruption, their distribution and dispersion are just too high. And when Bitcoin, let's call it the granddaddy, is moving, both focus and liquidity are sucked away from the broader altcoin market. Hence, currently only a handful of alts are moving in short-lived and isolated bursts to the upside, while major alts haven't gone anywhere. Let's take Sol, for example. It is still sitting in the same $15 range, narrow range, since early February. It is not yet time for alts to shine. That's the conclusion. So where does this all leave us? At the moment, things across risk-on and crypto markets in general look promising, but one has to keep in mind the overall general market conditions. Crypto is just a little part of it. We are seeing indeed repeated moves to the upside from BTC and Ether without losing the established baseline support, despite the ongoing geopolitical challenges, as we've discussed so far. That said, the current calm and stability might be deceiving, is not yet set in stone. Instead, both this calm and stability, perceived stability, they remain fragile with strong volatile effects on asset prices when things go in other direction other than expected. So this can change actually on a whim. So let's see how this week goes. It started very good. Let's see how it ends. That's all I've got for this one. Thank you for watching.